All right, everyone, welcome back to the Seven Figure Seller Summit. Today, we have a special session. We're going to have this roundtable where if you're thinking about selling, you're going to learn how to grow your business, how to prepare your business, and actually sell your company for top dollar. And we have three special guests to give you the full picture from all sides of the equation if you want to sell your business. We have a seller. We have Kellyanne Fidio. She's a seven-figure e-commerce entrepreneur, and she's an alumni of the summit. Some of you guys may have remembered her past interview, how she built and exited her business. So she's with Amazing Exits right now. And then we also have an aggregator, Jeremy Bell from Elevate Brands. Okay, so he'll give you some perspective on the buying side. Okay, he's Elevate Brands Chief M&A Officer. He has 15 years international deal experience. Really passionate about helping sellers achieve lucrative exits for their FBA businesses, and very experienced as an Amazon seller himself. So he knows what he's talking about. And also our friend Don Hennig from Accrumi. He's from Brooklyn, New York.
Brooklyn.
Born and raised there. And Don has a wealth of experience as an entrepreneur. I mean, he's been in finance, he's been in publishing, mortgage, real estate, even entertainment in the movie industry. I mean, this guy has a wealth of experience from all sides. He came out of retirement to found Accrumi, and he can really help you guys with one of the biggest bottlenecks, funding for your business. So, he'll come in from this perspective. So I'm super excited, guys. We have this roundtable. I think there's going to be a ton of value shared. I really hope that you guys will be able to, get some real good takeaways. Okay. So on a high level, just to give you guys the game plan, we're going to discuss the importance of growth in the last 2 years prior to an exit to your sale. We're also going to walk through, how to obtain growth capital with no interest and no required payments. Also going to review the key things you got to be able to do to sell your company and why, and also look at the current multiples out there being offered and how to get the highest offers possible, and also talk a little bit about the earnout provisions. Okay, how do you get the most money post sale? Okay, so that's a mouthful, and I like to kick things off and hand things over to Kellyanne, and this is going to be like a conversational style roundtable. So Kellyanne, how are you doing?
I am doing awesome, Gary. Thank you so much for having me back and for that fabulous introduction.
Absolutely. I'm glad that you're back. So let's get into this, Kellyanne.
Let's get into it. Well, as you know, Gary and Jeremy and Don, I am uber passionate about helping Amazon entrepreneurs plan for their exit. And I really want to say that the reason that's so important is that gives you choices, because if you plan for an exit, you are going to have the most well-oiled machine, the most well-optimized, profitable business possible. And then you might decide that you don't even want to sell. If it's spitting out cash flow, if you have it completely systematized, that's just going to make for a better business and a better lifestyle, right? So, I didn't start out this way. I didn't come to, know all this by osmosis. I really went through this process by selling my own business, and I sold it, and we closed back in February of 2020. And when I was going through the process, I really fell in love with M&A, which is mergers and acquisitions, and that whole world and funding, and just decided that, this is my next calling. This is what I want to do. Is I want to help other Amazon sellers make their business as profitable as possible, profitably scale them. And, if they choose to, be able to sell them for what's probably going to be their biggest payday someday. And so along the way, I started a podcast with my good friend and fellow seven-figure seller, Paul Miller, and it's called Amazing Exits. And through that podcast, we have been so blessed to meet so many awesome entrepreneurs, so many awesome service providers, great people such as Don Hennig from Accrumi, who's here, and all the aggregators such as Jeremy, and everything in between, every kind of service professional, SaaS company, everything that it takes to build a successful Amazon or e-commerce business, we've got to interview, and it's just been fabulous. So super grateful to be here. So what I want to do, kick it off, is, let's start with Jeremy. So Jeremy is with Elevate Brands, formerly Recom Brands. First, let's tell us a little bit about the reason for the name change, Jeremy.
Thanks. Nice to meet you, everyone. So we used to be called Recom Brands. We started on Amazon in 2016 in retail arbitrage, and we built that business up to, it was like a $15 million revenue business. And we had something like 70,000 SKUs. And when I joined Recom, just over 18 months ago, like we started to look at the strategy, and what we realized was private label and building brands on Amazon is just a much more attractive business model, because you can, like the same amount of money we would make selling 10,000 SKUs, like we could just have one listing that was killer and we'd make the same amount of money. So we sort of, started looking at acquisition targets, and we realized that there's a lot of different businesses that you can buy. And, we've sort of pivoted into focusing now on building brands and acquiring kind of private label businesses. So we're about to announce a big Series A and fundraising. So we've got, really well financial now, and we're just accelerating through building and buying more and more brands. People call us aggregators. I don't like kind of getting painted with the aggregator brush, because I've got photos of our founders walking around shops with like big shopping trolleys just full of stuff that they were reselling online. So like that's our DNA. We're not a bunch of like ex-Wall Street people trying to buy businesses for 4 times and list them on, for 20 times. Like we want to build a portfolio of brands, and that's the strategy. And the thing that I get really passionate about with this stuff is the way that sellers show up for an exit, and how well they're prepared for that. That can be the difference between them getting what they want, but also walking away with a river of gold. And like, we all know how hard it is operating an Amazon business. Like you've got to deal with listings getting shut down, hijacking, Seller Central. Like it's a really hard business model. So, how you show up and prepare for your exit can make so much difference. So like, I could talk about this all day, and it's, I'm really passionate. That's part of the job that I love, is speaking to sellers and just learning about their story and what they can do to really, prepare for the exit. So excited to be here.
Love it. I have that same enthusiasm, and we all learn as Amazon sellers how to sell on Amazon and all the latest tactics and strategies. And like you said, it's difficult. I mean, this business model has been, really gained traction back in 2013, and it's always been kind of marketed as, get rich quick. And I would say that it's simple, but it's not easy. And especially just keeping up with the changes alone on Amazon is like a full-time job. So I can tell your passion for Amazon sellers, because you are an Amazon seller. And I'm so glad you brought out that point. But I want to ask you, if you don't want to lump yourself in with the aggregators, what should we call you? Because sometimes I do feel bad lumping you guys all together. So what would you like to be referred to? As an Amazon acquirer, or?
No, we sort of, we're an Amazon acquirer, but we sort of look at ourselves as like entrepreneurs who are building a big business. And what we're really excited about is we love the e-commerce thematic. We want to build just a portfolio of great brands that provides really good experiences for customers. Because if you can keep doing that, like that's what we've found is kind of the winning formula on Amazon. Have a great product, get good reviews, your SEO improves, and then the flywheel just kicks in. So that's kind of what we're focused on.
Awesome. So I'd love to hear a little bit more about how you transitioned from, you started out as Amazon sellers, had a huge retail arbitrage business, and then you realized you wanted to pivot and do the private label model. And so from there, how did you go from that to then deciding, okay, now we want to acquire brands and build this portfolio of brands?
So when I joined, I've got like a private equity and mergers and acquisitions background. So like my job was just buying companies, and I sat down with the 2 founders, and we were looking at like how we could grow. And one of the founders, Ryan, he's got this thesis that there's a lot of baby boomers who are leaving they're retiring and they're selling their businesses, and someone's got to come along and buy those businesses. So we looked at like all sorts of different types of opportunities. And the one that just made the most sense was Amazon private label businesses, because we already had all the infrastructure in place. Like we've got the experience to kind of manage, 70,000 SKUs. So plugging in the private label piece, what we had to get really good at was the marketing, branding side, and like the PPC side. So that was the skill set that we had to develop out. But because we had good networks, like that came pretty quick, like building out that playbook. So what we did was like we bought one business and we said, let's give it a crack and see how we go. And we bought the business. 2 months later, we got black hat attacked. We ran out of inventory. Like revenue was 70% down, and it took us 3 months to recover. And now that business is up like 150%. So there were some dark days there. And then at the side, like parallel to that, we launched a product, and within 4 months of launching it, we generated like 2 million in sales. So we sort of said, look, we backed ourselves to do it. And, like that's part of the reason why we talk about ourselves as operators, is because like we've sort of done it and we have the track record. So that's a part of it that we find super exciting, is we can buy businesses, but then we're also launching businesses too. So yeah.
That's awesome that you have that breadth of experience, because I think a lot of the aggregators, they bring that M&A, financial private equity background, but they're not necessarily Amazon business operators, right? And so you guys brought that to the table. And, I didn't sell my company to Elevate Brands, but if anybody that's going to sell your business, you want to know that it's going to be in good hands, especially if you're not getting all your cash up front, which is most likely the case. If there's some kind of a performance-based earnout or stability payment, you want to know that whoever's acquiring it is going to be able to, you pass the torch to them, and they're going to be able to grow the brand, not only just for money's sake, but also these brands are like our babies for sellers, right? We put so much blood, sweat, tears, sleepless nights into them. And we don't just want to sell it and just forget about it forever. We want to see them thrive and go forward. And I know that that's how I felt when I sold my brand. I knew that the acquirers had big vision to grow it to the next level, and I was ready to pass the torch. And so that's super awesome. And so you kind of tested the waters with one brand, and then I'm assuming that you built out your operations from there.
Yeah, exactly. So as we kind of built out those proof points, we raised a little bit more money. We bought more businesses. They started to do great, and then it just became this like snowball effect of, we had this great track record, and that's a platform that we use to raise all our money off. So yeah, I think that's sort of what differentiates us from a few of the other sort of newer groups, because they just don't have that track record. They don't know Amazon. Like the people selling the business actually know more about Amazon than some of the people buying it, which is the scary thing when you think about it, because they don't know what they don't know. And I think anyone who's sort of operated an Amazon business for a long time will just be nodding their head quietly saying there's a lot of pain with running these businesses, whether it's trying to find capital, stay in stock, dealing with like 1-star reviews. Like everyone knows the pain points. And I think that's something that we've sort of lived. And I've had sleepless nights too. Like when that business revenue fell 70%, like I didn't sleep for 3 or 4 days, but we got it back. So I think that's how we're slightly different. And also, it's the track record is important. The first business we bought, they were 80. So as people think about like how long can they run Amazon businesses, like this couple were 80.
Wow.
And it was more important for them when they were handing it over to make sure that we weren't going to run it into the ground. So it's cool. Like it's really, really cool.
That's awesome. I would also imagine from your viewpoint, it's so satisfying to be able to, pay out and buy these businesses and really change the whole financial future of somebody's life. What does that feel like?
I often say to entrepreneurs, like when they're thinking through what it means, because you get to a point in the deal where, like it's very exciting when you go to market, you meet a lot of people tell you a lot of stuff, and then you'll commit to one party and go through underwriting. And then there's always a period at the end of the deal where the seller starts to get quite sad because they realize like this chapter is coming to a close. Now, we'll probably talk about it later, but there's ways for sellers to be involved if there's earnouts and those sorts of things. But the chat that I often have directly with sellers at that point, because it always comes at a point in the transaction when the penny drops that it's over. I know a bunch of people on this call in this session have sold a business, so I'm sure you've all felt it. But like, there's a point, and I just remind them, I'm like, in 2 weeks, we're going to be putting millions of dollars in your pocket. Like, just think about how much you had when you started this business and how hard it was, and then think about what you can do next. And there's a couple of people that we've bought businesses off. and like they're on to like their fifth flip. So like, you know, go again, like you get the ecosystem, you know how to build businesses, you've been successful. If you've got a capital base behind you, like it's amazing what I think some entrepreneurs are going to be able to achieve. And then it's like, come back to us next time and we'll buy whatever you build in 2 years. So yeah.
That's an awesome segue. So definitely want to
Yeah.
put a pin in that and come back to maybe some of the reasons why folks have decided to sell their business. But you mentioned a couple times, you know, pain points that sellers have. One of those is capital. I don't know any seller out there that hasn't had issues with cash flow management and capital. So I'd like to ask Don a few questions about his company that he came out of retirement for, AccrueMe. And it is a very unique funding option for sellers. And I know I will not do it justice trying to explain it. So Don, why don't you explain to our viewers, you know, why you know, just a little bit more about your background, because you have such an amazing, varied background, and why you came out of retirement to start AccrueMe, and then what AccrueMe does.
Sure, sure. It's funny though, listening to you two, there's so many things that I want to add in about businesses that I've sold. Like, you know, you mentioned, you know, it's like your baby when you're selling your business and you want to sell it to the right people, and then taking that money and reinvesting it into the next one because you have more confidence and knowledge. My first business I sold was a pretty large mortgage company in New York. Took the money, immediately started a mortgage broker franchise, has never been done before, and built it to 765 companies nationwide and sold that maybe about 18 months long. Yeah, it was pretty crazy. Took that money, started a soccer publication, sold that within a year. You know, but the idea that you both said is exactly right. You care about these businesses, but after you sell the first one, it becomes a little, you know, you care, but it becomes a little bit more of a commodity, and you care more about your employees than anything else. And you care about just doing it again and again and again. And it becomes a challenge, and it's exciting. And I've done it, you know, many, many, many times, and it's fun. So yeah, I was retired. I was retired this time for 5 years, and I actually thought I was retired. My wife and kids thought I was retired. They bought me a T-shirt, you know, retired and all of that. And, you know, it was one of those things. I thought I was done, but I wasn't done. So what ended up happening was I reached out to an old friend of mine from the mortgage industry that I hadn't talked to in over 20 years. I was on the train coming out of Manhattan, sent him a quick text saying, "Hey, I hope all is well." That's it, you know. And you know how life is. Something pops into your mind, you act on it. You never know where it's going to lead, but there's a reason that you did. And he said, "Let's have lunch." And again, I haven't spoken to this guy in 20 years. No reason, just that was it. And we had a ball. And the next thing you know, we're talking about different businesses. And I kept telling him, "No, I don't want to do it. I'm done. Life is too good. I'm boating and golfing and traveling. I'm done." And then the next time we'd have dinner and he'd pitch me on another business or two, and I'd say no. And we would, you know, brainstorm these things, but I didn't want anything to do with it until he brought up Amazon and Amazon sellers. And I am, you know, very passionate about helping people build their business. And I'm very passionate, especially about helping young people, whether it be building their business or just, you know, enjoying life and figuring things out. I love doing those things. I don't need to be paid for them. So we started looking at Amazon, and, you know, certainly caught my interest. So we went out, I went to my accountants and I asked them, "Do you know any Amazon sellers?" And they gave me a few that they, you know, represented. Spoke to each one of them. The smallest one had $3,000 of inventory. Okay. The largest one was over $1 million in inventory. All of them said the same thing. When we said, "What do you need?" They said, "We need capital to grow." Like, really? You have over $1 million of inventory. You need capital. Well, we have so many opportunities. Okay. Go to the one with $3,000. What's your plan? Well, my plan is I want to make $1 million. And then she stopped and she said, "Actually, I want to sell $1 million, and then I'm going to make $1 million." And I'm thinking to myself, how are you ever going to do that when you're starting with $3,000? So we came up with a plan to provide capital to sellers more than anybody else would do. So double their capital, you know, seems crazy right there. Not charge any interest. Again, you know, completely different from anything else. No required monthly payments. So the idea there is you pay us when it's right for you and your business. So if you have opportunities to grow, don't pay us, use the money and grow. If you are flush with cash, it makes sense to pay us. And we no personal guarantees either. And we don't take any ownership in the business. All we take is a percentage of profits. And the way that we set up the percentage of profits is that we set it up specifically so the seller can't lose. So we get whatever percentage of the capital that we represent. So if we represent 30% of the capital, so the seller has $70,000 of inventory at cost plus whatever's due from Amazon, and we give them 30,000, so now there's $100,000 in the business. We represent 30% of the business. Cut it in half. We get 15% of the profit for that month. And it changes every month depending on what percentage of the capital we represent. And the most we will do is 50-50. So if the seller has 100,000, we'll give them 100,000, but we won't go to 101. We don't want to have more money in the business than them. So the most we will ever get is 25%. And there were times where we're down at 5%. And the way it works is that the seller makes so much more money than we do that, if they leave the money in and we leave the money in, our percentage of capital and our profit percentage goes down every month as their business goes up every month. So we end up getting a smaller piece of a much bigger pie. So
Wow.
The seller, it's pretty cool. And again, there's only one way the seller can lose with us, which I think is interesting, is if they take our capital and just leave it in the bank. Then they're paying us for no good reason. But if they deploy the money, they can't lose as long as they're earning a profit. And if they don't earn a profit, we don't earn a profit.
I love it. I love it.
It's
That's
kind of
awesome.
crazy.
Yeah. And Don, I'd love to just learn a little bit more about the like when you said most we can do is 50-50. If the seller has 100,000, then we can only go up to 100,000. 100,000, what is that based on sales or the amount of inventory they have? How do you come up with that number?
Basically $100,000 of capital. But if they have 200,000, we'll give them 200,000. Whatever it is. But the capital is your inventory at cost, plus whatever's due from Amazon, plus typically whatever's in the bank. So basically, we're giving them funding on what is due from Amazon before they even receive it.
This is their working capital. In other words, you're giving 50% of their working capital that's in the business.
Yes. And we're doing it for growth. And one of the first questions we always ask is, what do you need the money for? And if they say something like, we've got to cover our bills from week to week, that's really not for us. We're really about when somebody wants to grow their business. And what we're really inundated right now with new sellers coming to us, because after 2020, most of them had a really good year. And now they're looking at 2021 and they're saying, man, we can blow it out. There's so many opportunities. And if I can add one more thing, if I'm rambling, just stop me, but I'll add one more thing. When it comes to opportunities, speaking from a business standpoint, I can tell you that in my career, when I've seen an opportunity, I've jumped in 99% of the time. And if you miss that opportunity, if you don't jump in, you really miss the opportunity. You miss it forever. So nobody knows how long this e-commerce boom is going to be. I don't know if it's going to be a year, 3 years, 7 years. I don't know. But I guarantee you, one thing I'll guarantee you is it will change. It will change. I guarantee that. So if you see these opportunities right now, go get them. Do what Jeremy said. Go get those, start something new, learn the new products, develop something new, build it now while you have the opportunity. Go for it.
I could not agree more. I think your model is so smart. It might be a little bit more complicated than some of the other funding options out there, but let me see if I can simplify it a little bit and maybe compare it to just investing in general. So
sure.
If a seller has inventory that they are turning at a good rate and they know that they can scale by just reinvesting in more inventory, it makes perfect sense to borrow cheap money to go ahead and get that inventory rather than using their own money, which most of the time they run out of money because of the lead times and things for manufacturing. Borrow that money knowing that they're never going to have to pay you more than 25% of the profits. Is that correct?
Correct. And that would
Okay.
be the most.
And
Yeah.
so when you compare that, it is apples and oranges, but when you compare that to, a line of credit or doing it on a credit card or something at a very high interest rate, it's like this is money that you would not have had you not borrowed it. And now you're just paying back part of the profits. So I think it's a brilliant model. It does take a little while to wrap your head around it.
It does.
And in fact, Don, you were our first podcast interview, which we never released because the sound quality was crap, which we have to redo it. And I know now you've been out there on the scene.
I've improved.
Podcasted, yeah, no microphone back then. So we have to redo it. But I want to make this as simple as possible for sellers to realize that number one, cash flow management is a real stumbling block to scaling profitable businesses. It's difficult. Yes. So, we've got to have proper accounting, bookkeeping. You've got to, hopefully have somebody that's managing your cash flow. If it's not you, a part-time CFO that, knows what capital you need. And then you need to deploy that capital and make the highest ROI that you can on it. And what better ROI than proven inventory that has sold in the past, right?
Right. Absolutely. But what about risk? I mean, people miss this part because it's not as clear. But what about risk? When things are going well and you borrow money, all right, everything's good. But who predicted what happened last year with COVID, right? So we have sellers that went from earning a ton of money to losing money. And they were very, very concerned. One of them even said to me, if I had to make payments right now, I'd be out of business. And, we were with them the whole way through. But if you think about that risk, that if something goes wrong, that's unforeseen. And remember, we don't know what's in front of us. None of us know what's going to happen. But what's going to happen if you have a bank loan? They're coming after you personally, whether you like it or not. That's just the way it is. Your house is at risk. Everything you have is at risk. It's just the way it is. And with us, it's completely a business transaction. If you went under, we get as much of our money back as we can, but that's the end of it. There's no liability to you personally.
Yeah. Unlike an Amazon loan at 15% with personal guarantee. And, I know sellers who have had their, complete disbursements just wiped out by their Amazon loans. And so again, cash flow is king. So let's tie this back a little bit to, and back to bringing Jeremy and back to the conversation of, what it takes to scale a business. You need, profitable products to sell, right? You need to be able to fund those products. Jeremy, what are some of the other things? Let's say, I'm sure you deal with sellers all the time that come to you and maybe it's just not, the time is just not right. And what do you advise them, if anything? What kind of tips do you have to share with the audience about how to continue scaling? And then we can also tie that into when is the right time to sell a business? And we can all kind of chime in on that.
Awesome. So I think the scaling point goes hand in hand with getting ready to sell your business. And my advice to people is the right time to get ready to sell your Amazon business or start getting ready is the day you started it. And if it's not the day you started it, it's the moment this session ends. Because there's just some really simple steps that you can put in place. And it will make all the difference in the world when you come to pulling the trigger on going down the exit route. There's an acronym that we use, which is called I just tell every seller I meet, just get your GOAT on. And what GOAT stands for is growth, operations, accounting, and trenches. And growth means I get as excited about a business which is flat, which I think I can grow, as I do about a business which is growing. But if your business is kind of declining, then straight away that becomes very uninteresting for sort of the team and I when we look at it. So when we think about growth, what you need to, typically what we get really excited about is we'll meet a seller and they will have a really good story about how you can grow their business if you buy it. And that includes, I've got a bunch of new SKUs that I launched 6 months ago and it doesn't have the full 12-month revenue coming through. I've got a pipeline of SKUs I'm about to launch. There's new markets which I'm about to hit, like Europe or eBay or other non-Amazon channels. They've got a really strong growth narrative. And that often directly ties into capital because most sellers, a lot of sellers I meet, we're buying a business and the guy stocked out for 4 months last year. it's super cool to be here with Don, because having access to capital and continuing to invest in growth is key. The next one is like operations. As you scale your business, the simpler it is, the easier it is to integrate into the buyer. So like implement standard operating procedures for things like how you organize your shipments, how you order your inventory, customer service. If you've got a team of virtual assistants, like what they do, how all that functions, like that just makes it really easy for like the ops team to look at the business and say, that just plugs straight in. The other thing I'd say is like, your friend's basement is not the right place to store your inventory. Send it to Amazon or use a 3PL because it's much easier. Like I've spent 5 hours in someone's garage counting inventory, and we had to count it 5 times and we still didn't get it right. So like just simplify your operations in every way you can. Accounting, like go and hire a CPA. If you've got a big business, go and hire a CPA. It's one of the best things that you can do, because clean books, the cleaner your books are, the easier it is to understand. And if there's no questions around whether your numbers are accurate or not, it's just a red flag that just falls straight away. So messy books equals a lower exit price. Hire a good accountant. There's a bunch out there. And then also like just have one bank account. Like don't have, I met a seller once with 16 bank accounts, and they did it because they had like, they opened all these new bank accounts to get credit cards. Because they used the credit cards, they maxed them out to buy inventory.
They should have used a crew me. They could have
Exactly.
Yeah.
Yeah, it's like, had he met you, he would have been in a much different situation, because like we just couldn't piece together the financial picture. Like when we went through all the different accounts, it just boggled our mind.
And that causes doubt and risk, and thus ultimately a lower valuation, right?
As soon as you lose the trust of a buyer, like the deal falls away. So like when we meet sellers, it's like, if you've done anything like black hat or gray hat, just tell us, because we're going to find out. And I'd much rather know that you launched a SKU and did like a rebate giveaway to get some reviews in, because eventually we'll figure it out, and then like that trust like starts to chip away. So that's the other point. And then the final point is, as you're scaling, is get your trenches locked in. So it's the last T in the acronym GOAT. And trenches means like, get brand registry. Like go get your trademark registered in the US and Europe and China and all those other regions, because it just de-risks everything for us. Like we've walked away from deals where they didn't have a trademark and they sold the business. We lodged a really strong bid. Like we loved the business. We smashed the bid out the park, and the brokers were like, you guys that's a really, really strong bid. Like you're in a really strong position. Basically means you're going to win the auction. But then news came out. It's like they don't have a trademark, or the trademark was rejected and they're reapplying. And in the end, we couldn't get comfortable on it, so we pulled out. And we were the number one bidder. So like get your trenches locked in. Like register your trademark, sign up for brand registry. Enroll in whatever else it is to make your Amazon business higher quality. Like get UPC codes, put transparency labels on your packaging so you don't get hijacked. A whole bunch of stuff like that. Like go claim all your Instagram handles, your Facebook handles, your domain names, like a bunch of just good tangible advice like that, because all of that takes like literally a couple of hours to do most of that. So you can do that as soon as the session ends, because then as a buyer comes along, it's like, we'd love to sell the product, but someone else bought the domain name, is like pointing the listing to, like pointing that website to a random blog. Like that's kind of, it just makes us think about like, maybe the multiple in this business isn't worth as much. So yeah, that's my advice on people scaling to an exit. Like GOAT is the acronym that we use.
I love it. I love that.
So Kellyanne, just one quick thing, following up with Jeremy on that, it sounds to me like all of those things with GOAT is what he's telling every seller is the first thing you should do is call Kellyanne. And seriously, like, not for anything, I've sold businesses, and I told you about my first business that I sold and some of the big mistakes I made. But one of the big mistakes is not setting it up properly, just as Jeremy just said, and you said earlier, Kellyanne. I didn't know. I was young. I was, 30 years old. I had no idea what I had. I didn't go to the right consultant. I didn't go to the right lawyer. So my attorney was a friend of mine in business. He was great, wonderful man, terrific guy, screwed me royally by not on purpose, by accident. He did what he thought was right. And it was really, really, really bad. So going to somebody like Kellyanne day one is the smartest thing anybody can do. And I'm not really pushing you. I'm just being honest. I've sold many businesses. That's what you have to do. If I was selling an Amazon business, or if I was an Amazon seller thinking I'm going to sell a business in a year, 2 years, 3 years, I want to talk to you today and figure it
Wow.
out.
Thank you for that glowing recommendation. I mean,
It's just the truth.
I appreciate that. What Paul and I do, or our mission, is really just to empower entrepreneurs, to educate them so that they have this information before they go talk to Jeremy, or before they hire a broker or an M&A firm to help them sell their business, so that they have the education and the knowledge. It's all about planning and being proactive. And I really think, Jeremy, it fits in with your trenches and your acronym. It's like having a real business, you need to know what it's worth at all times. And in order to do that, you need to have your operations in order. You need to have good accounting. These are all things we talk about on the podcast. I mean, first and foremost, you have to have good bookkeeping with accrual-based accounting, a good CPA. And when it comes time to then actually sell your business, you're going to want a good M&A attorney to represent you, not, your Uncle Bob, who happens to be a lawyer, right? All of those things. There's so many things to plan for, but spend just an hour or two a week on this stuff as part of your operational system. And it'll be a piece of cake when you do decide to actually go to market. That's what we're preaching all the time. So great points there, guys. I want to talk a little bit about, because the topic, we're talking about exits, of course, but we're also talking about scaling. We're talking about funding. And we've mentioned the word stock outs. And all sellers know how devastating and detrimental that can be to a business. So I want to kind of kick it back to you, Don, and learn more about the funding that you do. I'm assuming it's mostly for inventory. I honestly don't know if it's also for other capital needs that the seller has, but how important it is to avoid stock outs and how you guys can help out there.
That's why we're so busy right now. Is every single call we're getting, people are showing us, yeah, we're doing great, but we ran out literally in the last 4 or 5 months, we ran out 4 times. And what's going on? So they're all in the same boat. I'm telling you, we're inundated right now. People need money to, rebuild their inventory. People are seeing the opportunities to start new products, and they just need to do it. So what we do is we don't give a seller money for starting a new product. So we don't want to invest in something that's unproven. However, what we do is we give them capital, and then they can take their capital out of the business. So if they had $75,000, let's say, and we gave them $25,000, okay, they could take that $25,000 out right now, start their new product. We're not seeing it. We're not counting it. But now that product is profitable for 2 to 3 months, and we'll count it as capital again. So their capital account goes straight up, and our profit percentage comes down. So it works in their best interest. So
that's super smart. You're actually protecting the seller by doing that. And again, it goes back to what's a good way to deploy your capital. Do it in proven products where you know exactly what your ROI and your profit's going to be, not on something new, right?
Right, exactly. And nobody argues with us over that. They all get it. Everybody wants more money, but they get that we're not going to invest in something that's unproven. But we don't need it to be proven for 2 years, 2 to 3 months. We want to help you grow. So if you can get this product to be profitable in the next couple of months, we want to support you and give you more money if you need it. It's that simple.
And just
Don,
to kind of pick up on.
Sorry, Jeremy. Can I ask a quick question to Don before we go back to you?
Sure.
All right.
You're up.
Thanks. Don, when you say, it can be like 2 or 3 months of sales history, right? Do you have any criteria when it comes to sellers? Maybe they're just a new seller. If they only have 2 or 3 months history total, is that someone that you would still talk to?
First off, Gary, great question. And we will talk to anybody. And personally, I talk to just about every seller that comes through our door, because I want to get to know them. I want to root for them. I want to cheer for them. I want to, if I can introduce them to somebody that's going to help them in their business, I want to do it. So I talk to just about everybody. And so, yeah, if they started just a couple months ago, we're not going to give them money. But what we will do, our rules are pretty easy. We're looking for you to be a successful seller for 6 months, minimum 6 months. So that's pretty easy. A minimum of $10,000 of inventory at cost. And we add in whatever is due from Amazon as well. So, there were times when we're giving somebody $5,000. And our Wall Street partners have said to us, why are you doing this? Why don't you have your minimum as $100,000? It'd be so much more efficient. And they're right. And my argument back to them, totally honest, is that we want to help the small guys too. They're going to sell their business down the road. They have to make a living as well. We want to help them go from $10,000 to $100,000 and $100 to $1 million and so forth. And that's what we're about. So our average deal right now is pretty small. It's like $40,000 or $50,000, but we don't turn anybody down because they just have $10,000. And even if they're lower than that, we want to have a conversation with them.
Awesome. Thanks for clarifying, Don. So sorry, Jeremy,
pleasure.
back to you.
Yeah, I was just geeking out on like one of the cool features of your kind of financing package, because I'm a numbers guy, is like if a seller goes and draws down like the Amazon financing loan or a credit card, like the amortization on or repayment of that facility doesn't stop. Whether you stock out and you don't have any profits, like
Exactly.
you got to pay. So like that's the cool thing about your model is like if a seller goes and buys like a live case with our businesses, we're trying to get inventory as quickly as we can out of China, and there's like a 2-week backlog in LA. And we're looking at businesses to acquire. We're seeing it in our own business. Like there's a 2-week hump there, and then there's probably going to be a massive backlog at FBA when we get the inventory in there. So that's fine. Like we're probably going to be out of stock for maybe 3 weeks on some parts of the portfolio where it's been impacted by that. But yeah, you just need a flexible financing package to get you through it.
Absolutely. So you think about it, you brought up Amazon. And again, I'm not going to talk badly about Amazon or any of the other funding facilities. There's a purpose for all of them. But, when you look at the Amazon deal, it's a 12-month term. And it's not so much the interest rate that concerns me, but it's the term. And that's the longest one. All the others are shorter than that. And what that means is that the payment is high. So that takes away your opportunity to grow. When you have a high payment, imagine you buy a house for $500,000. All right, so your monthly payment is going to be $2,000. All right, well, wait a minute. We're going to give you that $500,000 for a year. Oh my God, so my monthly payment is going to be $45,000. I can't afford that house. It's the same idea. So, also think about the Amazon loan. Let's say you took out a $100,000 Amazon loan today. All right, now you're in Q3 and Q4. It's down to $30,000. You don't have the money to grow when you need to grow. They don't give you a new one until you pay that one off. Where with us, we give you $100,000 today. 4 months from now, you might be flush with cash and you're going to pay us down. Let's say we're down to, $50,000, but your business has now grown. Now you're getting into Q3 and Q4 and you say, hey, Don, I need another $50,000. It's in your account in an hour. It's literally that fast. But now your business is not a $100,000 business plus our money, but now you might represent $130,000 of that business or $150,000. We'll go up to $150,000 if you need. So now you have the opportunity to grow in this case, in Q3 and Q4. Take advantage of it. Go for it. We'll give you the money to do it. Now, when you're flush with cash, don't let it sit in the bank. Give it to us. Send it to us. We make less money by you doing that. We're happy to do that. So it works really well from a growth standpoint, and you end up saving money because it's so flexible.
Yeah.
I couldn't agree with you more.
Yeah,
go ahead, Gary.
Yeah, sorry. Don and Jeremy, I think this is very valuable for a lot of sellers, especially as they grow. They have to put more capital back into the business to buy more inventory. I've spoken with 7-figure sellers. One of the reasons they've exited, is, they've crossed 7 figures, right? And to get to that next level, they're going to have to like double the amount of money that they pour into their business, right? So I think that's one valuable benefit, because you can kind of, you can get money from, I'm kind of putting this in layman terms, like you can just get more money from Accrue Me rather than, investing your own money, right? But I think
exactly.
at the same, yeah. But at the same time, what if you're like an intermediate level seller? You're only doing like 6 figures, and it's a matter of, okay, I have, I got that monthly payment from Amazon. It was like, I mean, that, biweekly payment, it was like $25,000. Okay, I can either put that money back into inventory, or I can pay myself, to pay my bills. That's kind of the trade-off. And a lot of times, that's a difficult decision, right? I mean, for a lot of sellers, myself included, because, we're solopreneurs, right? Do you guys have, like, to better illustrate for the people watching today, maybe like a case study where, let's say, seller A, put that, that $25,000, put that back into the business 100%, and then their growth, and then, what an exit potentially could look like, versus someone that, used to crew me, maybe with that, they got money from crew me, maybe like, 25,000, and then what like higher growth rate would be. I know, like, Don, you have some slides, and Jeremy has any slides. I'm kind of putting you guys on the spot here, but I think that would really help, people understand that are more like visual learners like myself.
Yeah, we have a case study that we're coming out with shortly. It's not in slides. It's more of a detailed presentation that I'm not prepared to give it right now because it's not finalized. But it compares the growth of a seller with a CrewMe versus the other funding vehicles that are out there. And it really shows you the difference. And when, if you wanted to actually maximize the growth, if you were really going all out, I'm going to sell my business in 2 years, I want to grow. Yeah. That seller will do ridiculous. There's nothing that comes close to us. Nothing. Right. It would be impossible to. Right. But I will tell you just one other quick thing as far as a case study. Our first client, who we didn't have any technology, we literally gave them money with no, we didn't know if we'd ever get it back. They're still a client. So it's 2 years, they're still a client. But in the first year, they increased their revenue, I'm trying to remember now, 6-fold, and their profit 8-fold. And they came back and they said, we never could have done it without you. And they're right, they couldn't have. Yeah. And the reason they couldn't have is that they're retired and they didn't have any more money. Their retirement plan fell through. Their retirement plan was a business they sold, and they were done. And they were just putting their toes in the water here. But then they had to make a real living. And truthfully, thank God that we were there. And it's a great thing to see.
That is a great point, Don. I want to tie this back to and bring it back to Jeremy about how, like, let's just use that example of how using AccrueMe Capital, they were able to 8x their profits, how that's going to impact evaluation when you go to sell. So maybe, Jeremy, would you mind talking a little bit about, how businesses are valued and, how you guys look at businesses and, especially, it's obviously usually a multiple of EBITDA, but maybe just explain for the viewers a little bit about how businesses are typically valued in a financial transaction?
Awesome. Yeah, happy to. So the way the market values Amazon businesses for sale is we calculate what's called either EBITDA, which is earnings before interest, tax, depreciation, and amortization. So it's a financial term. The other term that gets thrown around is SDE. You'll see a lot of brokers talking about like SDE. SDE means seller's discretionary earnings. And really what we're trying to solve for when we do the numbers is like, how much profit will we, the buyer, make from this business going forward, excluding like financing costs, tax, and depreciation. So like if you go to like the Prosper conference and you fly there in a private jet and you blow a lot of money in the casino, and you put that through the business, we add that back. Like that's not included in calculating your profit. And then likewise, if you're paying yourself a big salary, again, like we'll add some of that back to calculate your SDE or your EBITDA. And then what we do is we then apply a multiple to that figure to arrive at what we call kind of the purchase price or the enterprise value. And then there's different groups approach it different ways. Some brokers will take the SDE, times it by a multiple, and then plus on the inventory value. Other brokers just say the bigger the deal is, the more EBITDA. Like the Wall Street convention kind of takes over, where it's just the inventory balance is included in your multiple. So it just depends on how big you are in terms of like if your EBITDA is like, 3 million north, then like the buyer pool there is probably more private equity to bigger aggregators, sophisticated investors. They won't think about adding inventory to that kind of balance. It's just not how it's done at that end of the market. So yeah, I guess in terms of like what guides the size of the multiple that you get, like depending on how big your business is if you're like a 6-figure seller, the multiple range, and like you're really what I don't concentrate too much on revenue. What I concentrate on is what rules my life is EBITDA and SDE. That's all I care about. Like, because I'm valued off earnings, so I'm going to value your business off earnings.
Mhm.
And the things that get me excited is like, do you have a really strong, healthy profit margin? Because if you do, then I know if I have to compete on price, like there's a bit more buffer there. Like, is your business growing? Like, if your business is growing, and I think that when Elevate buys a business, we're going to be able to grow it, then like I can pay a higher multiple because I know in 12 months' time, when I look back and recalculate the purchase price, if I've doubled the business, like it's going to be like the valuation is going to be a no-brainer. And then a lot of it just ties into that kind of the kind of principles of GOAT. Like if you're doing all that really well, you've got a higher quality business because everything's in place. The other things that we look for, like, is do you have a review moat? Are you the SEO leader? Do you have like a relatively simple supply chain? All those things kind of feed into multiples. Everyone always asks me like, what multiple is right for my business?
Yeah, everybody wants
Mhm.
to know the multiples that everybody's paying.
Everyone wants to know. So, I can give you a range. It depends on like how much SDE your business generates. There's a website called centrica.com, and they've got a marketplace watch. You go to it, you punch in, the range of SDE or profit, and then it just spits out all the businesses which are listed on the market today. That's what the market's paying. So like,
Yeah.
I could give you a range, but like, yeah, do you want to jump in, Gary?
Yeah, sorry to jump in. Two really interesting things you mentioned I'd like to expand on. One was that website. What was the website again? And two, you mentioned what like a healthy profit margin. What's a benchmark that sellers should try to shoot for to attract buyers?
So the website is, and it was probably hard with my thick Australian accent.
Centurica. Centurica.
Yeah,
Centurica. Okay.
CENTURICA.com.
That is a great site. We've had them on the podcast. So great site, great resource.
Yeah,
Great. We'll
great
link that up
site.
in the show
Or the
notes.
FBA broker, Corin Woodmass, like he's got a really good weekly email and a really good report that summarizes what happened in the last 12 months. You download that, and that's a really good summary of the market too. So two great resources that I kind of direct.
We've had Corin on the podcast as well. He's an alum. He's very knowledgeable, the FBA broker.
Yeah, great resource. Like really good resource.
Fellow Aussie as well.
Yes, yeah, he is. It's good to have another one in there somewhere.
Yeah. How about profit margins, Jeremy?
So profit
what's a good
margins,
benchmark? Yeah.
Typically we like to see anywhere from kind of, if it's below 20%, we start to like, we'll need to dig into, and that's 20% EBITDA margins, or SDE margins after like all your Amazon costs, PPC, 3PL, COGS, like all those expenses. So typically what we like to see is above 20% as a minimum, because it means, above 20%, 20 to 30% is kind of the sweet spot. If it's above 30%, everyone gets excited, because we know that there's a lot of margin there. But the thing that we think about with businesses where the profit margins are above 30% is because that's kind of rare. Like, does that mean you're making, like if you were selling PPE product last year,
Right.
your profit margins could have been like 50%. Like that's not going to sustain itself. So like we spend a lot of time thinking that if the business makes really strong profit margins, is that going to sustain itself long term? So yeah, 20 to 30% is kind of the norm. So sellers should kind of target within those ranges. That means like your COGS, it should be kind of 30% or less. Like
Jeremy,
less.
are you including the seller's operating expenses in the EBITDA calculation? Because a lot of these businesses, they are run lean and mean by solopreneurs without teams. And so they can achieve, that EBITDA of, 25+% because they have really lean operations. And are you discounting that at all when you value the business?
We don't, because we've got the team. Like our approach is we'll look at your kind of the profit margins of your business and the expenses, and we'll do a fair process of adding back what we think isn't a business expense.
Mm-hmm.
And then that lands a view on what the EBITDA margin and profit margin is. And if we think that your EBITDA margin should be lower, we'll reflect that in our multiple. So we don't say to sellers, because the problem is like, if you ever have a dispute with a seller around valuation or the numbers don't stack up, it's very easy for us to just say calculating EBITDA is just math. And then if that declines by 10%, we just apply the same multiple to it, and that's how much price changes. So we concentrate on, we reflect all those factors in the multiple just to keep things simple for the buyer. Because I know there are buyers out there that when they look at EBITDA, they'll say to the seller, "Oh, I'm going to add like a 50 grand expense to it and like decrease that number." That's not how we approach it. We just keep it simple.
Yep.
Yeah.
Excellent, guys. Don't mean to cut you off. We have about 5 minutes left.
Wow, where's the time gone?
Time
Okay.
just flew by. Did we want to talk a little bit about the earnout provisions and how to get money post sale, or what do you suggest we close out with?
I think it'd be better to zoom out a little bit and talk more about just what's the process of selling your business like. Maybe tie that into a little bit, if we can, in 5 minutes, timing, what's good timing. We've touched on that a little bit. You want to sell on a high note. You don't want to try to sell your business after it's plateaued or declined. And then, like the typical deal structure, Jeremy. And then I'd love to bring in Dawn for some final words too, just on, how to best, leverage Accrue Me as a funding source to scale and to, exit for your biggest payday.
Awesome. So in terms of timing, now is a great time to sell your business, because the market, a lot of businesses did really well in COVID. So earnings are high. That does present a bit of a challenge for buyers, because we don't know how much of that is maintainable. But that kick happened in March last year. So it's pretty clear who had a one-off kick from COVID and whose growth is going to sustain itself. So now's a really good time, because a lot of businesses have done really well. There's a lot of capital. There's a lot of cashed up buyers who have come into the space. So that wasn't around 2 years ago. And some of those buyers have different experience and in Amazon, and some in my view, there's assets that we've passed on because we've just looked at the data and we're it doesn't make sense, but someone else has paid a huge valuation for it. So it's a good time to exit. I think 2021 is the golden year to exit Amazon businesses, just because there's so much capital, earnings are really strong. It's peak cycle. So now is a great time to sell. If you're growing your business and you're still somewhere in that growth curve, think about how much more runway do you have, and continue to push that. So yeah, there's sort of personal factors and business specific factors that go into when you sell. I won't get into that now because we don't have enough time, but the market timing right now is strong.
I couldn't agree more with that. I absolutely do. And you don't know when that's going to plateau.
Well, I think it'll plateau into, there's two things potentially that are going to cause it to plateau. One, everyone who's invested money and raised money, if they don't do a good job of growing these businesses, they won't be able to raise more money. And so those buyers will probably exit, or they just won't be able to raise more capital. So they'll disappear. So they're all buying businesses now. Everyone's scaling up and buying businesses. So that'll be one factor. The second factor is a bunch of businesses being sold right now have huge COVID kicks in them. And people that haven't priced that incorrectly, they're going to start paying for that mistake in 6 months' time. And again, that's going to go into their ability to raise capital. So, now's hot. Now's a really good time. So cool. In terms of deal structures, the kind of standard deal structure we see in the market a lot is 80% cash at close, 20% to an earnout. The simplistic read through of the earnout is if the business grows post-close, in the 12 months post-close, you as a seller can make more money from the continued growth. Everyone is structuring them differently. Some have a revenue share, some have it linked to revenue growth, some have it linked to EBITDA. It just depends on the buyer. My advice on that is keep it simple and make sure the math is really simple and you can't get gamed by the seller. because the seller knows, sorry, you can't get gained by the buyer. The buyer knows more about how to manipulate the math there. Hire a lawyer, as Kellyanne said, and you won't get screwed there. But the key thing is, if you think the business is going to grow, make sure the party that you're selling to can actually grow. Like, make sure they've got that track record, because there's only a few operators out there that do. And I think we're one of them, and there's a handful of others.
That's great. I have one last question, and I want to get some final words from Don. So this is kind of a rhetorical question, but when is the best time to start planning your exit? Not actually exiting, but when is the best time to start planning for an exit?
I think you should always be ready. Like honestly, like if you run your business well, you will be ready to exit at the drop of a hat. And you know, it's not hard. Like, have really good filing systems, build out that just focus on the go, and you'll be ready to exit at any point in time. So like you never know what life throws up. Like, it could be a personal problem. It could be, you know, you're not as bullish on the niche. Like, whatever the factor is, just be exit ready. Because if you want to exit quickly, that's a beautiful thing about Amazon businesses, is you can sell them in as quick as like 4 weeks. So if you are ready, then you can pull that trigger really, really quickly.
I couldn't agree with you more. That's amazing advice. So Don, before we wrap up, you know, any final words to share with the viewers about, you know, borrowing capital, cash flow management, you know, using the funds wisely to scale, and then also increase the value of your business?
I'm just going to say 2 quick things. And one relates to what Jeremy was talking about. And that final year, you want to not run out of inventory. You just don't want to run out.
Right.
So, you know, grow in that final year. And, you know, when I used to coach baseball, like, you know, little league baseball, we would teach the kids early on, you know, run through the bag, not run to the bag, but run through the bag. So, you know, don't slow down. So if you slow down, and we've seen it with sellers getting ready to sell, and they take some money off the table a little too early, you know, they think they're doing the right thing. No, that's the wrong thing. You want to have full inventory going into your sale so that your earnout starts off up here, not down here and catching up. So,
absolutely.
Yeah. So that was one thing. And the other thing I'll leave you with is this past Friday, I was talking to a seller, and he nailed it. He said to me that our model, the Accrumi model, is like going to a rich relative to get money. It's the best deal in the world. He said, but what's even better is I don't have to sit down at dinner with them. And it's true. We kid around about that. I literally sent him a PowerPoint 2 seconds later called The Rich Uncle. And it was one I did, you know, weeks before, you know, just, it's exactly what he was saying. So that's what we're about. We're having a lot of fun doing it, and we love helping, you know, sellers grow. So that's basically
super evident. You're great. You're genuine. And I can attest to, you know, you're there for everybody. You truly want to help you. I mean, you're financially free. Like, you're doing this because you want to help entrepreneurs. I mean, we all need to make money as we're doing things, right? But that's, you know, when you get to your stage, it's all about, you know, giving back and helping.
Absolutely. So, 100%.
Love it.
Yeah, it's fun. And how about you, Kellyanne?
Yeah.
Well, let's see. Final words of wisdom. I mean, so many of them we've touched upon tonight. It's you always want to have an exit strategy, be proactive. You always want to know the value of what potentially is your biggest asset. I'll also add that, you know, all the cash flow stuff we've been talking about tonight. I mean, really, when you make money in this business, it's when you go to sell it. If you're taking money out along the way, you're never going to be able to grow it. Or scale it. It's just starve for capital. So, you know, use other people's money, OPM, you know, such as Accrumi, where you can get that money at a really good, you know, price, let's just call it, and be able to grow your business so that then when it comes time to sell, you're going to have more EBITDA and a higher multiple, and you know, a higher exit that can allow you to become financially free.
That's great.
Excellent. Well said. Well, we're out of time, guys, and thank you everybody for coming on. For people that want to, you're welcome. And for people that want to connect and learn more, could we quickly go around the table and just share what's the best way to connect? Let's start with Kellyanne, then Jeremy, and Don.
Sure. Well, you can find me at our website at www.amazingexits.com. My email is kelly@amazingexits.com. I'm very active on LinkedIn, trying to be more active on both Facebook and Insta. So you can find me at Kellyanne Fidio.
Perfect. And Jeremy?
Awesome. So you can find me. I hand out my email address. I love speaking to sellers. Jeremy@elevatebrands.io, or go through the website, elevatebrands.io, fill out the form, and we'll be in touch, super quick. Again, active on LinkedIn and the other channels. So yeah, can't wait to connect if you're thinking about exiting.
Awesome. Thank you.
And
Don?
for me, the website is accrueme.com. And my email is very simple, just don@accrueme.com. And on LinkedIn, it's my full name. So Donald Hennig at Accrueme, Donald Hennig on LinkedIn. And I love talking to people and I love connecting with people. So let's do it. Let's have some fun.
Perfect. Well, this has been an excellent session. We have the full picture, right, from the Amazon seller side with Kellyanne, the buyer side with Jeremy, and also the funding side with Don, also known as the rich uncle. So this has been great. And thank you,
More
everyone.
ways than one, Gary.
Yes. So thanks, Kellyanne. Thanks, Jeremy. And thanks, Don, for putting this together. And thank you, everybody, for watching. And we will see you guys at the next session. Bye, everyone.
Bye.
Thank you, Gary.
Thank you, Gary.
Bye, everybody.